If you have clicked on this video, the chances are that you are looking to avoid the same costly mistakes which most ISA investors do make, right? Don't worry, I've got you covered. In this video, I'll reveal 6 of the most common pitfalls people fall into when using ISA products, and more importantly, how you can avoid them to make smarter, more profitable investments. Hello everybody, as part of this ISA series, today we'll discuss common ISA mistakes which we as an investor should avoid. Before jumping into these mistakes, let's understand different types of ISA accounts. Well, for those who don't know, ISA stands for Individual Savings Account, and this means that any returns you make on these accounts are free from tax. In the UK, there are 4 major types of ISA accounts: Cash ISA, Stocks&SharesISA, Innovative Finance ISA, and Lifetime ISA, also known as LISA. And there is a Junior ISA, which has a separate limit of £9,000 each tax year. And the first mistake which most investors do make is not understanding its main purposes. So our mistake number 1 is ISA is not an investment, but it's a tax advantage account. The UK government has introduced a very good scheme called Individual Savings Account, known as tax-free investment account. It's kind of a bank account, which literally means that you can park or invest your hard-earned money tax-free, completely tax-free for your future benefits. As per one study, this is by far one of the biggest tax advantages government is offering to each and every individual. And this tax advantage facility is the most generous in the whole world. UK's taxation year starts on 6th of April and ends on 5th of April every year. So we are approaching the end of 2024 financial year. And so if you haven't already, then please do max out your ISA allowance. And this leads to mistake number 2, which is not all ISAs are flexible ISA. There are 2 types of ISA accounts, a regular ISA and flexible ISA. So basically what happens is, in your regular type of ISA account, when you put in your money and withdraw your money in the same tax year, then your ISA allowance limit, which is £20,000 each tax year, which we get it, will get affected. And we'll understand this by this example. Let's suppose you put in £6,000 on the 14th of April, and let's say you've got the bonus from your company and you've again put in £8,000 on the 2nd of August. But all of a sudden, you withdraw £2,000 for holiday purposes on the same month on 18th of August. And again, you put in back again on 5th of September, £2,000, that same money. Then your total money would be £16,000. So it will count as £16,000 you've done for all the transactions, and your ISA allowance left is £4,000 for that particular tax year. In your flexible ISA, it basically calculates the total money that you paid into that particular ISA account, as well as whatever money you withdraw in between in that particular same tax year, obviously. Then the example would look like this. So as you can see from this example, your ISA allowance would not get affected. So it's always best to choose this flexible ISA. Please do double check with your platform provider, especially your ISA account provider, that are they flexible ISA. Mistake number 3 is cash ISA is not for investments. Yes, this is one of the biggest mistake which many investors do make, and that is parking cash unnecessarily into cash ISA. And in fact, we have noticed that a lot of people unnecessarily park their cash into cash ISA, and they don't understand that they cannot grow by putting their cash into this account. And in fact, this is also one of the reasons why government is planning to limit cash ISA in the future, and the limit which they are planning is around 4,000, which is equivalent to lifetime ISA. instead of parking your hard-earned money into cash ISA, you could have opted for stocks and shares ISA for a better return and future growth and compounding and all that. But people in the UK would like to play a safe game, and this will erode the value of their investments on a long term. So the money which already been taxed won't gain a future return. And another fact which they forget is in the UK, government gives something called personal savings allowance, which means a minimum threshold where you don't need to pay any taxes. As per UK government's website, basic rate taxpayer, which most people are, could earn interest on their investments of up to £1,000, and above this limit there is tax to pay. Now when we apply the simple mathematics here for basic rate taxpayers, in order to go above £1,000 personal savings allowance at the current rate of 4.5% interest, basic rate taxpayers would need to invest £22,250, which is not going to happen. However, those who are wealthy and would like to park their cash could have better advantages here. In my opinion, cash ISAs are for emergency funds. Cheapest alternative to emergency fund is high interest savings bank account. I recommend Money Saving Experts website, where you can find the best options. Mistake number 4 is junior ISA has a separate limit, and a lot of new investors aren't aware of this. A junior ISA has a total of £9,000 limit, which is separate to your £20,000 limit. Now, if you have already utilized your £20,000 ISA limit, and if you have a children or grandchildren, then this is a very good way to pass on wealth to your future generations. You can open a junior ISA account and invest some money using low cost ETFs within this tax advantaged account. At 9% average return, if you put in £300 each month from the day they born, they will have about 155,000 by the time they are 18. Now, if you want to max out your £9,000 junior ISA limit, then you can put in £750 each month, and they'll have £389,000 when they turn 18. Mistake number 5 is considering partners allowance transfer process. Now, this is not a mistake, but sometimes it says that if you know something is better than knowing nothing. So let's understand what this is all about. Now, let's say, for example, if you have a spouse and if they have investments into their cash ISA or Stocks and Shares ISA. Now, all of a sudden, if they die, then the value of their ISA, whether it's cash ISA or Stocks and Shares ISA, wherever they have parked their money in their investment, is subject to additional permitted subscription, which means you could keep their ISA on top of your 20k ISA allowance. It's always best to update your account and assign a nominee beforehand. So just in case if ISA provider deny to action APS, known as additional permitted subscriptions process, then you could withdraw their money and you can park it in your ISA. This is the mistake number 6, ways to avoid withholding taxes. This is a very common mistake which each and every Stocks and Shares ISA investors do make. So when you open a Stocks and Shares ISA, you might have noticed that platform providers may ask you to sign a particular form called W8BEN form. Now, this means that if you are investing in USA companies, then USA takes a cut of 30% in the form of dividend withholding tax. So if you are a UK investor investing in the USA, then you need to sign this form so that you can get the rebate of 15%. So if you're not aware of these kind of forms, then please do check with your platform provider and sign it today. So what are your thoughts on these 6 mistakes which I have discussed today? Please do let me know in the comments below.